There seems to be some confusion about what happens with your super when you retire. Is it mandatory to withdraw it or turn it into an income stream? In today's video, I'm going to explain the options you have with your super at retirement. Hey there, I'm Chris Strano, the founder of SUPERGUY, the place where Australians go to maximise their super and build their own retirement plan. If you're new here, make sure you click the subscribe button and all the links related to this video. You can find the links in the description below this video. Remember, this is general information only, and you should consider whether it's appropriate to your personal needs and circumstances before acting on it. Let's dive in. Right now we're going to discuss what happens to your super when you retire. So while you're working, contributions are made by your employer into a superannuation accumulation account. Now, some of you, maybe those working for certain government organisations or within the Defence Force, may have what's called a defined benefit super account. I will discuss defined benefit super accounts at the end of this video, but the main discussion will be for people who have ordinary accumulation accounts, which makes up the very large majority of Australians. Okay, so while you're working, your employer is required to make compulsory contributions into your super account on your behalf, and these are known as superannuation guarantee or SG contributions. You might even be making additional personal contributions or salary sacrifice contributions. If you're self-employed, you might be making personal contributions, or your business might be making contributions into your super accumulation account. So when these contributions are made into your super account, they get invested into whatever investment options you've chosen to invest your super into. And this super accumulation account grows and grows and grows until retirement. But what happens to your super when you do retire? Well, basically it's up to you. So say that you retired and you were to do nothing, absolutely nothing with your super. In this case, it would simply remain invested and just continue to earn within the account, bubbling along. If you had met a definition of retirement for superannuation purposes, such as retirement after reaching your superannuation preservation age, with no intention of returning to work, which is basically gives you full access to your superannuation once you meet that definition, then you could simply leave your superannuation in an accumulation account and make withdrawals from your account whenever you need the money. It's as simple as that. Alternatively, and more commonly, what happens is with your super is that you use your super to commence a retirement income stream. So basically, in practical terms, your superannuation accumulation account balance gets transferred into a pension account, still within the superannuation environment, and your pension account balance continues to be invested and earning just like it was in accumulation phase, and you can still choose exactly how you would like it invested, based of course on the investment options available within your super account. But there are two main differences between an accumulation account and a pension account. Okay, firstly, if you convert your accumulation account balance to a pension account, you must draw an income from your pension account, and the amount of the income that you must draw is determined by your age and the corresponding pension factor or percentage, which you can see in this table. This income can then be used to cover, your day-to-day retirement expenses, maybe holidays or other expenses that might pop up. So you can usually choose to receive the pension income broken down into monthly payments, quarterly payments, half yearly, or even just a one-off annual payment, depending on what your super fund allows. But you must receive at least the minimum pension payment amount each year. Even if you don't need that much income, it must be taken. All right, let's do an example. So let's say that you're 62 years of age and you've got $500,000 in super in accumulation, and you retire and you use that total balance to start a pension income stream on 1st of July. Okay, as you can see in the table, the minimum income that you must draw in the first financial year is equal to 4% of the account balance because you're 62 years of age, which is $20,000 per annum. If you start the income stream partway through the year, this amount is pro rata. So for example, if you started exactly halfway through the year, you would need to withdraw at least $10,000 in that financial year. For an ordinary account-based pension income stream, which is what most people have when they retire, there is no maximum threshold. Okay, so as long as you withdraw the minimum amount, you're all good. Now, some people might say, well, if I don't need that much income for whatever reason, why don't I just leave my money in accumulation account and make withdrawals from the account whenever I do need money? Okay, because accumulation accounts have no minimum withdrawal requirements. In fact, you don't even have to withdraw anything from your accumulation account, even if you are retired. And yes, you can do this. But it leads me on to the second main difference between accumulation and pension accounts, which is that the benefit of converting your accumulation account balance to pension phase is that all of your investment earnings received from your pension balance are received completely tax-free. Whereas in accumulation phase, those same earnings are taxed at up to 15%. So in both accounts, as you can see, accumulation pension phase, your balance is invested, could be in an identical way, but in pension phase, all of the earnings are tax-free. In accumulation phase, up to 15% tax on the earnings. So based on a balance of $500,000, let's say that your investment or that capital earned, 5% during the year, which equates to $25,000 in investment earnings. So in pension phase, there would be no tax. This $25,000, the total amount would be added to your account balance. However, if that same $25,000 was earned in accumulation phase, you would pay up to $3,750 in earnings tax, which is 15% on the $25,000, and therefore only $21,250 would be added to your account balance in earnings. Does that make sense? So you can see the benefit of transferring your money into a pension account, although like I mentioned earlier, you must receive at least the minimum pension income amount each year if you do. And it's as simple as that. This is what happens to your super when you retire. You can leave it invested in accumulation phase and make withdrawals as you see fit, but all earnings are taxed at up to 15%. Or you can use the balance to start a retirement income stream, receive regular income to cover your retirement expenses, and all earnings are tax-free. That's it. Okay, so as I promised, for all of you out there with defined benefit super accounts, I mentioned I'd go through what happens with your super when you retire. So basically, all members with a defined benefit super scheme have their retirement benefits pooled along with everyone else. So it's in a pool of money while you're still working, rather than held in individual accumulation accounts. Then when you retire, your final retirement balance is calculated using a formula, which is based on your wage and your years of service. And at that point, at your retirement, you're required to make a decision. Okay, you can either take that calculated amount as a lump sum payment. B, you can roll over this final retirement benefit amount to a superannuation accumulation account or pension account. Or C, you can opt to receive a defined benefit pension, which is generally a guaranteed monthly pension income amount indexed with inflation for the remainder of your life. Some defined benefit super schemes will allow you to choose a combination of those, maybe partly lump sum and a lower guaranteed monthly income amount. The options that a defined benefit member has once you retire is dependent on what the defined benefit scheme allows. So they're all a little bit different. Defined benefit schemes are not as prominent as they once were, and some these days don't even provide the option of defined benefit pensions. They say you've got to take a lump sum or you've got to roll over to another superannuation provider, and that's it. Well, there you go. I hope this video was helpful and you now have an idea of what you might be able to do with your super at retirement. Let me know what you're thinking of doing in the comments below. Also, make sure you like, share and subscribe for more videos on superannuation and retirement planning. If you're looking to build your own retirement plan, then I highly recommend checking out our premium program, the Super Guy Hub. Head over to superguyhub.com.au. Thanks for watching, and I'll see you on the next one.